No, I don't think so. I think that we're going to get eventually a central bank in this country that is going to be much more serious about prioritizing price stability. And when that happens, you will start to see the long end of the curve move down a bit. The problem is we haven't seen that yet. We have a Federal Reserve that is not willing yet to rhetorically tackle sticky price inflation, let alone attack it through higher interest rates. We had a meeting in April of the FOMC, and what did they do? They couldn't even muster a majority to change the bias away from easing. And yet, inflation break-evens and the inflation swap curve does not show a convergence back down to the target anytime soon.
Here's the money. Folks, this is the key distinction. This is what Wizman was brilliant about at Bear Stearns years ago, and now at Macquarie worldwide. Terry, what's so important here is Governor Myron yesterday saying it's supply shock this, shock, demand shock. Forget about it. It seems to be a regime shift in inflation. Discuss.
Yes, there are 4 things out there, or at least maybe even 5, that I've been highlighting for the last few years that are going to cause structural inflation, not just in the U.S., but globally. Demographic changes, climate change and climate remediation efforts, global conflict, just to name 3 important ones right there, okay? We are living with those things, for now, and we don't see a solution globally. At least certainly we don't have the kind of leadership around the world that's willing to tackle these things head on. As a result of that, we're going to have structural inflation. We have had structural inflation. But now we're facing something different. We're facing a war, okay? Not just the prospect of global conflict, not just the prospect of global conflict enduring for the next 10 years, but an actual full-fledged war. And if you look at U.S. history, I'm going to extend this to say global history, but let's just take U.S. history. You go back to the War of 1812, through the Civil War, the Spanish-American War, World War I, Korean War, World War II, and Vietnam. All of those wars have been inflationary. So why should we be that surprised that this war is inflationary? Wars are inflationary for a variety of reasons. People hoard goods during wars. You have supply chain disruptions during wars. You have fiscal stimulus by virtue of the war, and sometimes you even have central banks that are willing to finance that war with cheap interest rates and money printing. That's been the historical example. That's the reason we have inflation now. And I'm concerned, and I think the Fed should be, as I mentioned, that we may have second-round effects if inflation expectations go up, as they seem to be, if you look at the curves. This inflation may result in more stickiness than even the Fed or the general public presumes right now.
Well, I mean, Kevin Warsh taking the job today, I'm sure he feels the pressure from the White House, and that's part of the reason maybe why he's even there. But boy, the data doesn't support him doing anything but at the very least sitting on his hands. And I think that's kind of what the markets are telling you.
Yeah, I think the compromise at the FOMC will be to change the bias, to move it away from easing towards neutral and then sit there and watch things. That may not be enough. But I can tell you that the president probably for political reasons is concerned. I think the reason his poll numbers are down is because there is some inflation. But remember, the president does not have to rely just on the Fed to get this inflation down. Certainly he doesn't want to rely on the Fed to get this inflation down. That would mean higher interest rates. I think he can rely on maybe cutting federal gasoline taxes. He can rely on an export ban for crude oil and product. Those are things that he might rely on in the next few months if gasoline prices in the U.S. climb further.
They're not even band-aids, I would argue. Are they material for the marketplaces?
Yeah, I think they are. I mean, look, not the federal gasoline tax that might shave 20 cents off the price, but you could have the states do the same thing with their excise taxes as well if they follow through. But I do think a crude and product export ban, if it's done right, would reduce the price of gasoline.
Can I do a Friday Global Wall Street? They're all in their cars heading out to the Hamptons.
Sure.
Terry Wizman with his folks, and we're going to cut to the chase. DXY 99, yen after multiple, interventions, backs up to a 158.55, rounded up to 159. Let's go all Rudiger Dornbusch, 1976.
Oh boy.
You can't have a unilateral intervention. It just doesn't work. How alone is Japan this weekend with a log convexity I see in yields?
Yeah, look, it's true that interventions don't work, but they certainly don't work when the fundamentals are going against you on top of that, right? And the fundamentals that Japan and a lot of the oil importing countries are facing right now is high oil prices. It's no surprise that the yen should be the currency that's attacked by the speculators, because Japan is an industrial economy that produces no oil, no basic energy of its own, hardly any. If you look at the dollar, on the other hand, the U.S. is a net exporter. So it makes sense that the public, that the trading public, will want to buy dollars and sell yen against it. The fundamentals of high oil prices are actually quite good for the U.S., when you don't consider anything else that might be happening in that context.
Do you have just one final question? I mean, there's so much going on, Terry. Do you have in your head, I'll let you pick the duration. Sweeney would go with a 2-year, the benchmark, I'm old school, 30-year. Do you have a yield that's a tip point where it unravels?
Well, if you're talking about the stock market unraveling, the stock market does, I think traders do pay attention to round figures, to big round figures. So 5% on the 10-year, another 50 basis points, although albeit it's very far from here, I think could be that kind of event if it were to happen. We're not there yet. I guess we're at about 4.6 this morning. But you get a few more high inflation prints.
Yeah.
You get a Fed that is unwilling to do what is necessary in the face of that inflation. Yeah, you're going to see the 10-year yield of 5. And I think at that point, the market might finally start to crack.